Let's talk about an interesting story. The wedding season looms, yet fashionable outfits see low demand. Now, why are we looking at the slump and who is buying? Here's an exclusive report from my colleague Sesa.
Right, the first 3 months of this year have seen a slowdown in India's wedding apparel market, defying expectations of a big fat wedding season. Major players have reported sluggish sales in the March quarter as consumers cut back spending on discretionary goods to cope with rising cost of living. Vedant Fashion, the company behind Manyavar, reported a 4.5% decline in same-store sales in the March quarter, while Raymond Lifestyle saw revenues drop 11%. Luxury labels, which are often considered recession-proof, have also seen their sales take a hit. Sabyasachi, for instance, saw its sales growth dip from 56% to 15%, in the March quarter. Now, experts point to 3 key factors that have led to this weak sales. While the bride and groom continue to indulge in their aspirational brands, their families and other guests are spending less. They are even, reusing wardrobes and buying fewer outfits, suppressing demand. Secondly, a broader cultural shift is impacting sales. Executives say that the couples in metropolitan markets are increasingly opting for Western style and less traditional outfits. And thirdly, the market is also affected by a surge in new stores, especially in the non-metros. Now, the new brands that have come up have led to increased competition, with established brands struggling to turn their stores profitable amid muted demand environment. Despite these challenges, however, few brands have bucked the trend, such as Taswa. Retailers, however, remain cautiously optimistic about the upcoming summer wedding season. They expect a higher number of wedding days to lift up sales as inflation settles in and consumer confidence begins to recover.
Okay, that was an interesting story that we are looking at in terms of where the retail demand is. But let's talk about the big brokerage call of today, and that is UBS, which has upgraded Aarti Industries to buy, seeing a 25% CAGR growth between FY25 to 28. Is recovery on the horizon for this stock? To discuss more about this, let's bring in Harsh.
Well, yes, it's a double upgrade, in fact, so it's a large one, and now offering a 30% plus upside to current valuations is Aarti Industries as per UBS. They've hiked the target price as well, just marginally, from 615 to 625. They're saying strategic growth initiatives are likely already playing out, and that is impacting or will start impacting the numbers as well. You're also seeing a cycle recovery, which is likely, is what they say. Now, we've been waiting for that cycle recovery, but UBS says that now that is on the anvil, it's likely. Focus on market development and long-term client relationships. That's what Aarti is doing and probably doing right. Achievable EBITDA guidance is what they see. They forecast a 25% CAGR between FY25 and 28 with regard to EBITDA. So that should drive the numbers going forward. The energy business is expected to ramp up gradually as well. So all of those factors likely to aid the stock. Target price 625, 30+% upside.